The following presentation was recorded live in Pittsburgh, Pennsylvania for the 22nd Annual International Association of Square Dance Callers. This is tape number 7, Everything You Want to Know About Management.
This is the partner's first session, Everything You Want to Know About Taxes, and I'm sure a little bit more. I was going to do the introduction of Constance Eads. Here on my right, the only thing I know is she is Director of Finance for the Urban Renewal of Pittsburgh. But she said she likes to talk about herself, so I'm going to let her do her own introduction. So this is Constance Eads.
Karen, we could start with the handouts. I'm probably going to start sitting and end up standing, and if anybody has any trouble hearing me, and I'm going to adjust the microphone, I'm an amateur at microphones. I told Karen that I would give her my background, and I never got around to doing that because I'm a procrastinator. And so I'll tell you what my background is. I'm from Karen's hometown of Parkersburg, West Virginia. I went to a high university and got a degree in radio, television, broadcasting, and I worked for a year in television and thought, this is really not for me. I think in my heart I'm truly an accountant. So I went back to school and got my degree in accounting and made my mother and father very proud. And from a high university, I came to Pittsburgh in 1979 and went to work for one of the large national accounting firms, Arthur Young and Company, which is now Ernst & Young. I was there for about 4 years and had the great opportunity to leave there and become the Vice President of Finance for a broadcasting company, which kind of brought the broadcasting background together with the accounting background, and I was there for about 8 years. From there, I went to work in a school for emotionally disturbed children, where some said that I fit in very well. I didn't know what to make of that, but... And then I started my own small accounting firm. A couple of years ago, I was contacted by the city of Pittsburgh. They needed some help with the Urban Redevelopment Authority here in their accounting. So I became the Director of Finance and the Controller for the Urban Redevelopment Authority. So I work for government now. This is why I'm here, because there's no way you're going to get any other CPA on April 10th to come speak to you. So we'll muddle through this together. I'm a little nervous about doing this, and I was talking to my husband last night, and I said, what if they don't like me? What if I'm not interesting? What if I'm not good? And he says, Connie, remember what you're talking about. You're talking about taxes. You can't be entertaining. There's nothing entertaining about the tax code. So we'll try to make it as easy as possible. I think they're passing out some handouts here. We've got an outline, but we're flexible. If you have any questions, please feel free to ask, but since they're taping this, they do ask that you ask questions at the microphone. So we'll get started. As I mentioned, I'm a procrastinator, and I don't know how many of you are procrastinators, it being April 10th. I know Vic is, here in the front row. He said he was going to harass me all during this presentation. So I'm really looking forward to this. If you have not filed your tax return for 1994 yet, the best piece of advice, particularly since you're in the beautiful town of Pittsburgh at a very nice convention here, and that's eating into your time to prepare your taxes, is to file an extension to file your return. That's a Form 4868, which I meant to have in your handouts today, but it's not there. I was telling Karen earlier that I went to go pick up the handouts yesterday at the printer. There are 18 pages in there. I know this intimately well, and I had 150 copies of the handouts made. Went to pick them up at the printers yesterday, opened the box, and they had not collated or stapled them. So my husband and I...
I'm going to steal her mic for a minute.
My husband and I... we put the handouts together, but your Form 4868, which is your... Is this on? Your Form 4868 isn't in your packet, but you can get that at any bank. Accountant, except for me. And this will give you an extension. This will give you an extension of time to file your return. It'll give you till August 15th. A lot of people don't like to file extensions because they believe it's going to... I'm feeding back here. Well, you got a lot of pros.
Oh, yeah.
Oh, yeah.
Keep talking.
Okay. A lot of people don't like to file extensions because they feel that it's going to increase their chance for audit. It doesn't. Or they feel that, they don't have a good reason for filing an extension other than they just put it off or whatever. Well, on the Form 4868, they don't ask you why. It's an automatic extension to file. And you need to keep a copy of it and attach it to your Form 1040 when you file your return. What it does not do, though, is to extend the period of time for paying your taxes. So you need to come up with your best guess estimate of how much you owe in tax, compare it to your withholding and your estimated taxes or whatever, and just include that check with your Form 4868. I figure that's the most valuable piece of advice that you could get today, because if you go to an accountant today, they're not going to file your return. They're going to file a 4868 for you and probably charge you about $50.
So this is just filing this form, period, without the 1040?
Yes, it's called an extension of time to file an individual tax return, and you send that in now, and then you've got till August 15th of this year to file your 1040, and you'll just put a copy of that extension request. I always recommend put it right on top of your return so that when the IRS does receive your 1040, they don't automatically assume that it's late. This will prevent you from having to pay any penalty for late filing of taxes. However, if you don't pay enough in with your 4868 and you end up, when you do file your return, owing tax, it will not, just because you filed an extension, you might still have to pay interest because you're paying late with your Form 1040. The Republicans are doing the best they can to install tax reform. I think there's a lot of talk about flat tax rates and things like that, which will put a lot of accountants out of business. So I'm personally against it, but it would just make things way too simple. One of the hot topics that's going on, that accountants are talking about today, is the health insurance for the self-employed, which is of great interest to most, if not all, of you. Back in 1993, I believe, was the last time that you could deduct 25% of the premiums on your medical insurance for being self-employed. Well, the House has, it was originally a part of health reform, and we know, of course, where health reform went after the Clintons took office. So it kind of disappeared. They have brought it back. It has passed the House and I believe the Senate. President Clinton is expected to sign the bill that would reinstate the 25% deduction for premiums paid on self-employed medical insurance. He's expected to sign it by April 15th or April 17th. And it would be retroactive for 1994. Now, if you've already filed your 1994 tax return, don't worry about it. When they do pass that, then you can file Form 1040X, which is in your packet. The first part of your packet is kind of interesting things, and then the back part are some forms that will pertain to what we're talking about today. The 1040X is an amended tax return. That's if within 3 years of filing your return, you find that your situation has changed or you find an error or something that you made on your return, you have 3 years from the time that you filed your tax return to file a 1040X. If you've already filed your 1994 tax return and they do pass this medical insurance bill, and he does sign that, then what you're going to want to do is to file a 1040X if you pay your own medical insurance. I'm a conservative as far as filing taxes, so if I was filing my tax return today, since it was not signed, I would not take the deduction. However, I was talking to some of my friends who are tax partners in the national firms here in Pittsburgh, and on their return, as they are self-employed as being a partner of an accounting firm, they are taking the deduction now. If anything untoward should happen, then they could always file a 1040X themselves and increase their own income taxes. I skipped over the Section B there under General 1994 versus 1995. Being self-employed, whether you're just part-time self-employed or full-time self-employed doing calling, you should probably be filing estimated income taxes. Now we'll go over the details on how to file estimated income taxes later on, but I included your first, after the outline, your first handout is the tax rate schedules for 1994 and 1995. We're not going to go through this unless you want to go through that line by line by line, number by number by number. But I included it so that it would help in calculating your estimated taxes. There is no great increase planned for 1995. If anything happens, it's going to be decreases, I believe, given the contract with America. The next page is the other changes that are different from 1994 and 1995. The standard deduction is just going up, just like the tax tables that were on the prior page. They're just going up by a cost of living increase that's just built into the tax law. You can see if you take the standard deduction, if you don't itemize deductions on your 1040, if you're single, the standard deduction is going up $100. Head of household, it's going up a couple $100, and so on down the line. Depending on what your situation is with your personal taxes, this might make a difference. Maybe in 1994 you itemized, maybe in 1995 you won't be, but it's crystal balling on your part, I know, because it's only April and you have absolutely no idea what your income's going to be throughout the end of the year. The personal exemption has gone up $50. That's the personal exemption you take for yourself, for your spouse, and for each of your dependents. The Social Security limit is the amount above which your employer or yourself, if you're self-employed, will not withhold Social Security taxes. Social Security taxes, the limit is $60,600 and $61,200 in 1995. They broke that down into two parts a couple of years ago. It's now Social Security and Medicare tax. The Social Security tax has the limit of $60,600 and $61,200. The Medicare portion has no limit, so you could earn $1 million and you would still have to pay the Medicare portion, and we'll talk about that a little bit later on when we're talking about our self-employment taxes. The standard business mileage rate, if you decide to use that in your business or as an employee, is 29 cents last year, 29 cents this year. And the deductible portion of business meals and entertainment, 50% last year and 50% this year. Travel expenses for spouses since 1993 have become very, very difficult, if not impossible. In order for travel expenses, meals, entertainment to be claimed for a spouse, the expenses need to be paid by an employer to an employee. So the spouse would have to be your employee in order to have that as deductible. We'll find out later, and I'll repeat later on when we're talking about self-employment taxes, it's probably not a good idea anymore to have your spouse as an employee unless they truly are an employee. It used to be that you could have your spouse as an employee and not pay Social Security or Medicare taxes, but that's not the case anymore. Club dues are not deductible, except for club dues paid to professional associations. Do you pay dues to CALLERLAB? Well, those would be completely deductible. Country clubs, what they were going after was the country club type things. If you have if you belong to a country club, the dues are not deductible, but if you have meals or entertainment there, then if you take clients or prospective customers or whatever to the club, the meals would be deductible under the regular meal or entertainment expense. We'll go into that in more detail in a little bit, too. This is one that caught my husband and me, the withholding on bonuses, overtime, and commissions. If you have another job and you're just calling part-time and you happen to be lucky enough to get a bonus from your employer, they have the option of withholding 28%, a flat 28% on your bonus. Now, if you don't happen to be in the 28% tax bracket, which you can look at the tax rate schedules, you might be above, you might be below. This 28% could affect you adversely. So what you need to keep in mind, if you're employed and you have a bonus where they have deducted the 28% flat out of your bonus, you should adjust your withholding with your employer to account for it. I'll give you an example in just a minute. If you're not employed, or if you don't want to adjust your withholding, keep adjusting your W-4 form with your employer, then you can adjust your estimated taxes that you make quarterly. A couple years ago, my husband worked for Westinghouse Credit Corporation here in Pittsburgh. If any of you follow the news, you probably remember that Westinghouse Credit had a staff of about 700 people, and I think today they have a staff of about 4. So they were having massive layoffs. My husband, they didn't want him to leave too early, so they gave him an incentive to stay until he got laid off, instead of having him going out looking for another job. The incentive ended up in 1993 of him getting a year and a half of salary. They withheld, and this is on tape. Oh, great. They withheld in 1993 a flat 20%. Well, because I was working, he had worked through May, and after that point, he got a year and a half of pay. We had way over 2 years' income in 1 year. And so what I did to help my husband out is I adjusted my withholding at work. I upped it so that we wouldn't have to come up with a bunch of money when we filed our income tax, because we knew that 20% was way too low. Now remember, you get what you pay for here, you know. I forgot to adjust my withholding back in 1994. So I was way over withheld. Now, my husband decided to change careers. I'll back up here for a second. He'd been in banking for years and years and years and decided he really hated it and wanted to become a librarian. I thought, oh, great, I married a banker, now I'm going to be married to a librarian. I thought, great, he's going to be a librarian, I'm a CPA, no one's ever going to ask us to another party. So his income he went to school for a year in order to get his Master's of Science in Library Science. And he's doing very well. He's out at Robert Morris College here in Pittsburgh, and he's the head of business reference librarian out at Robert Morris College. And with his business background, he's just doing great, but he's making about half of what he made before. But he's so happy. He comes home with dimples in his face and everything else. We're just real glad that he made the change. But I didn't change my withholding. So this year, I'm doing our tax return on TurboTax. Vic was talking to me about TurboTax earlier. pull out the return off of the computer, and I looked, and I have over-withheld on myself $4,800. Now, do you know what kind of interest I'm earning on this $4,800? Very good. And I thought, and they want me to come speak to people about income taxes. I thought, oh, well. We'll go into the adjusting withholding, and I'll give you my lecture. Of course, I gave myself my own lecture. I took myself into my office, closed the door, and gave myself a good talking to. Charitable contributions. If you happen to make contributions over $250 to a charity, and this is at one time, the charity needs to give you a letter or a receipt or something along that line at the time that you make the contribution. Canceled checks are no longer accepted by the IRS as adequate documentation for contributions over $250. This doesn't affect like United Way. If you have United Way deductions, unless each payroll deduction is over $250, it doesn't affect that. So you could end up giving $1,000 to United Way over a period of a year, but you don't need to get any documentation back. The IRS is claiming that they are going to look to make sure that you're getting that kind of documentation from the charity contemporaneously with your contribution. So like if you would happen to get pulled for an audit 4 years from now or something, the IRS claims that they will not allow the deduction if you have to contact the charity to get another letter from them or something. So it's just a good idea to make sure that if you do have a contribution that large, get a letter, get a receipt. Cancel checks just aren't going to do it anymore. Okay, where are we here? Let's go on to Schedule C, self-employment income, which I'm sure is what most of you are interested in. This will be pretty basic run-through of Schedule C. And if you need more detailed information, just let me know, and we'll get into it in more detail as you go. But there's just so much. A Schedule C covers so many parts of the tax code. I thought we'll do a brief overview. If you need detail, we'll get detail for you. If you do your own tax return, you might be interested in filing a Schedule CEZ, which is a short form Schedule C. Much, much easier to fill out than a long form Schedule C. Schedule C is the form you fill out for your self-employment income. But in order to use a Schedule CEZ, you have to fall under the requirements that are in your handouts. I've got a Schedule CEZ in the forms part of your packet, and you can compare that to a Schedule C and see how much easier it would be. So if you do happen to fall into these guidelines, you'll see the advantage, particularly if you do your own tax return. Those requirements are if you had gross receipts from your self-employment of $25,000 or less. This is from your calling profession. Doesn't affect if you have salary or if you have another job, that's not taken into account at all. If you had business expenses of $2,000 or less, which after today I'm hoping that none of you will be able to use Schedule CEZ because we're going to show you how to get as many deductions as you can. We'll get above that $2,000 level. If you use the cash method of accounting, if you didn't have inventory, which I'm assuming most callers wouldn't have inventory, if you did not have a loss from your business, and if you only had one business. If calling is the only source of self-employment income that you have, then you can use a Schedule CEZ. If you have another business, if you do tax returns in addition to your calling or whatever, then you cannot use a Schedule CEZ. In addition, you can't have... I'm sorry.
Could you just say quick, is there another method of accounting besides cash return?
Yes, there is. The accrual method, and we'll go over that in the next section. All right. In addition, you can't have had any employees. You shouldn't take, you can't use Form 4562, depreciation and amortization, which we'll go over in more detail later. If you don't deduct expenses for the business use of your home, and if you don't have any prior year unallowed losses that you're carrying forward. A lot of that will become clearer as we go on. But if that's the case, then Schedule CEZ is enormously easier to fill out than a Schedule C. Also, even if you have somebody else do your tax return, it doesn't cost as much to have them fill out a Schedule CEZ as a Schedule C. We'll start with Schedule C and go on down through there. There is a Schedule C in your packet. And it's called Profit or Loss from Business. And we're just going to kind of go down through this line by line. Some lines we're not going to go into detail right now because they're too complicated. We're going to go on. We'll treat them individually after we go through the Schedule C. The first line, of course, is the name of the proprietor. That would be you. Your Social Security number. The business name, if it's no different than your name, you can just leave that line blank. Your principal business code, which is included with the instructions to Schedule C. Is there a question? Oh, okay. Oh, you look like you were about to do this. Okay. Sure. Yes.
One is involved in go beyond the narrow confines of being
What you want to do is as long as it's one business, okay, because you need to fill out a separate Schedule C for each business. As long as it's one business, all you have to do really is to get the one that closest fits a description of your business. If you think it doesn't affect anything. The IRS uses it to look at your deductions under your standard industry code to see if they're in line with other people who are in the same business.
I suspect that most of us at college have access to teaching schools. So are we an entertainer? Are we a teacher? Are we
well, when you're teaching in school, are you talking about calling? I would say that would just be a expansion upon the calling business. You know, that you're being called upon. I didn't bring the codes with me. Yeah, I mean it's a code. The code that you would normally use as a caller, even though you do teach in schools, or you might do something that is just related to calling but not exactly calling. I would assume that most of your expenses would be related to the calling part of what you do. That's what the IRS is going to look at when they plug in that standard industry code. They're going to plug in all your expenses that you put on your Schedule C and compare it to other callers. But I've never, ever heard of anybody being called up for audit because they got the wrong number on there. Okay. The employer ID number here, you would just leave blank if it's just you. If you're just a sole proprietor with no employees, because you probably wouldn't have an ID number other than your Social Security number. So you would just leave that blank. If you do have employees, then you would have an employer ID number, because you would need to have one in order to pay payroll taxes on your employees. And if you do have one, you would just put it in that blank there. Now let's talk about accounting methods. That was a question before. The two main methods of accounting are the cash method and the accrual method. The cash method is where you would record income as you received it. Maybe on December 25th, you called it a square dance, and didn't get paid for that for some reason until like the second week of January. Under the cash method, you would record that income in the year that you received it. Okay. Now you need to be careful with this, is if they give you a check on December 27th and you just don't happen to deposit it until the second week of January, that doesn't count. You received it. You had constructive receipt of that income in the prior year. So you need to report that income in that year. Also under the cash method of accounting, your expenses are deductible as you pay them. So maybe you talk to your accountant or something, throughout the year, but they didn't bill you until the following year. Under the cash method of accounting, you would not take that deduction until the next year. The accrual method is a little more complex, takes a little bit more accounting ability than the cash method, but still very handleable. For someone in your profession, I would suggest not using the accrual method of accounting because the cash method gives you some flexibility that you don't have in the accrual method. And you also, in the example I used before, if you did the calling on December 27th, under the accrual method of accounting, you would record that income that year. For your business, you earned that income on December 27th. If they don't pay you until June of next year, then you have to pay taxes on income that you haven't received the money for yet. Of course, it works the other way too. You can also accrue some expenses under the accrual method of accounting that you haven't truly paid yet, but there is a 2.5 month limit to how long before you pay the expense that you can take the deduction. For instance, if in the accountant example, you met with your accountant, they gave you a bill in, I'm going to say 1994. You would accrue that expense. Well, they didn't. I'm sorry, I'll take that back. They did not give you a bill. You would have to accrue that expense for 1994, and then you would have. I'm confusing myself here. Okay. You would accrue the expense in 1994, but you would have to pay that within 2.5 months of the end of the year in order for that deduction to stand if your 1994 return were ever audited. So I think the flexibility, you can, like at year end, arrange with your customers, clients, to not pay you till January, for instance. If you want to defer some income into the next year, under the cash method, then you could not pay any income tax on that income and pay it in 1995. The next line is inventory, which I'm assuming that would not apply at all to square dance collars, mostly used in like a manufacturing or a craft type business. And then question I, did you materially participate in the operation of this business during 1994? Yes, you did. If you don't, if you have any questions about this, and you put in no, then and you end up having a loss, then you can't take the loss. And materially participating in your business is actually going out and doing square dance calling. So I think there's absolutely no question at all that you do materially participate. For income, your income would include your fees earned, and if you charge for expenses and someone pays you for your travel expenses or incidentals, that would also be included in income. The travel expense reimbursement, I'll call it, is deductible under the expenses. Cost of goods sold would not apply to a square dance collar. That again mostly relates to a manufacturing or craft type business. Now let's go down through the expenses. This is the good part. That income's the bad part because that's what gives you the tax liability anyway. Now we're going to the good deductions. Advertising, self-explanatory. If you advertise your services, that of course is a deductible expense. The next line, bad debts, would only apply if you use the accrual basis of accounting. That would be if you billed for that December 27th event and they never paid you. What has happened is in 1994 you've taken that into income, but you never received it. So you would want to take that as a bad debt expense in the year that you determine that you're not going to collect this. Under cash method, you did the call on December 27th. You didn't take anything into income. They never paid you. There's no deduction. The net effect is zero in both cases, but there just would never be a bad debt expense under a cash basis of accounting. Car and truck expenses we'll go over in more detail in a little bit, which is also related to depreciation and Section 179 expense deduction. That's a good one. I like that one. Your insurance. If you have property insurance on your equipment, on your car, any lighting, any liability insurance that you might carry in your business, that's all deductible on that line. Interest. Yes, we'll get into that. If you use the standard mileage deduction instead of actual expenses, you can't take the insurance. But we'll go over that in just a second. Mm-hmm.
Excuse me, any questions? But they put the microphone because it's not what's not taking,
Yeah. If you have a question, get to the well, I'll tell you what. What if I repeat the question while we're in this? Okay. That question was, can you take insurance as a deduction if you use the 29-cent standard mileage method of accounting for car expenses? No, you can't, but we're going to go over that in just a second. Interest. Of course, the tax code a few years ago did away with most of the interest deductions, but if you happen to take out a loan for your business that's not personal, you can deduct that interest on that loan. If you took out a loan to buy equipment or something like that, then of course that is business related and is deductible here on Schedule C. Mm-hmm.
And also, like credit card purchase, specifically buying equipment for business, that would have interest on a typical credit card.
Yes. The question was, would it count if you bought a piece of equipment on your credit card and you incurred interest expense on that credit card? Yes, that interest would be deductible. If you ever got pulled in for audit, you want to make sure that you have deductions like that really, really documented, because they're going to really look at credit card interest askance to make sure that it's a business expense and not a personal expense. If there are other charges on your charge card, you need to do a little calculation to make sure that the interest that you're claiming as a deduction is only related to that equipment purchase. Of course, the other thing that you can also do, whether you deduct it here or on your Schedule A, your itemized deductions on your 1040, is if you have to borrow significant amounts of money, you can always do that under a home equity loan, which is still deductible on your Form 1040 Schedule A. Legal and professional services, if you incur legal expenses, which would include setting up pension plans or retirement plans for your employees if you have them. Accounting expenses, the cost to get your tax return done for your business, is deductible here. Just a little aside here, any expense that you can possibly take on your Schedule C, you should. There are a lot of limitations on miscellaneous deductions on a Schedule A itemized deductions form that you file with your 1040. For instance, the cost of getting your tax return done, if it's just a personal expense and you're going to put it on your Schedule A with your 1040, those miscellaneous type deductions have to total up to more than 2% of your income. And it's really hard to get expenses to total up over 2% of your income. Whereas if you take them on Schedule C, they're just an expense of your business, and there is no deduction. There is no deduction for this 2% type thing that you would take on your personal return. Pension and profit sharing plans, if you have employees. We'll go over a couple retirement plan vehicles in a little bit. Rent or lease. If you keep your offices outside your home, you can deduct, of course, any expenses related to that. If you rent property, if you rent your sound equipment or anything like that that you take with you to events, that, of course, is deductible. Repairs and maintenance on your equipment, on your car, but you can take those expenses in other places. Supplies, taxes and licenses. You can either put, I think most of you have to pay BMI ASCAP fees. You can either take them on this line or on line 27, your other expenses. Travel, meals, and entertainment. We'll go on the next line. We'll go over that in more detail in just a second. Utilities, if you have an office or a place of business. And then other expenses, which is where you would include your telephone bills.
I thought they turned around and started having problems with some of your office.
We're going to talk about home office deduction, but this would be, for sure, if you have utilities, if you have an office outside your home, any utilities or anything that you have to pay with that lease, of course, would be deductible. In fact, we could talk about home office now, if you'd like. They have really made this difficult, if not impossible. This is not in your handouts. These are my notes I'm flipping through here. You can deduct, under the home office provisions of the tax code, you can deduct certain expenses for operating a part of your home, operating a business in a part of your home, only if that part of your home is used regularly and exclusively as your principal place of business and a place to meet or deal with your clients or customers. The Supreme Court, I think this was about a year, maybe 2 years ago, ruled that the two primary factors in looking at whether home office expenses are deductible are, number one, the relative importance of the business that you do in your home office, and number two, the amount of time that you spend at your home office. The relative importance test gives great weight to whether you meet with your clients at home or elsewhere. Therefore, I think that it would be impossible for a square dance caller to deduct any home office expenses because you don't hold square dances in your home. You're usually doing them off-site. What if you do hold them in your home? Oh, I'd like to see your house. You must have a heck of a family room. If you do, then you can deduct home office expenses for the expenses related to the use of your home for those events. It has to be it doesn't have to be, but you have a burden of proof to prove exclusive use of that portion of your home for your business. Like if it's in your family room, for instance, you might have a little problem getting an IRS auditor to believe that you just used your family room for square dances, that you never did, once watch Matlock on the TV and eat popcorn in there. Mm-hmm.
What category would you consider advertising in the yellow pages of your profession?
Advertising, the question was, what category would you consider advertising in the yellow pages? I would put it under advertising. Mm-hmm. Exactly. Rather than home expense. Yeah. I was going to say something else about home office expenses. Oh, even if you can't, hold on just for a second. Even if you can't take the portion of your home that you use as a home office as a deduction, if you have equipment, If you get a photocopier, if you get a fax machine or a computer or software or anything in your home, you can still use that. The home office deduction deals mainly with a portion of your mortgage, repairs and maintenance on your home, and things like this. But any auxiliary expenses that you have related to equipment that you have in your home that you use for your business are still deductible. Yes, ma'am?
If you're doing something like a note service or book publications and you do that at home in this office, can it then be applied to this home office deduction?
Yes, but that's not related to your Square Dance calling.
Oh, yes, it
is. Is it?
Yes.
I'm sorry, what was...
It's a Square Dance caller's note service
Mm-hmm.
and Square Dance publications. They're books and notes for callers and dancers.
And you receive income for this?
This is the front side of your cassette.
As an anesthesiologist, of course, most of his work was done in an operating room putting people to sleep, but they probably don't like that terminology, but he did not have an office at the hospital that he could use for doing research or billing. He was responsible also for billing for his own services. So he had a room in his apartment that he solely used as a place to do research and to send out bills and to do his bookkeeping, anything related to that. Spent a lot of time doing that, probably spent more time doing that than actually in the operating room. And the Supreme Court said that his main business was in the operating room and would not allow him any deduction, even though they tried to prove the importance of the administrative end of the business. Now, the good news is that the Republicans are trying to get these home office deduction rules eased up a little bit, because there are so many people who are laid off, who are starting their own businesses. They really are too tight, because there are actually certain cases where people have gone to tax court and have ended up with no place of business. They work in a hospital and at home, and under the rules that the Supreme Court and the tax court has come up with, they end up actually with no place of business for tax purposes. Did you have a question?
Yes. I was told that one morning if you sell your home and you are part of it in office, it would have to be appraised as that part of the business separate from your home, even though it was attached.
Yes. The question was, if you sell your home and you actually did have an allowable home office there in your home, that you would have to get a separate appraisal on the business part of your home. For the purposes of selling your home, no, because the buyer probably doesn't care. But for tax purposes, the appraisal is always a good idea. Particularly if it's done by a third party, an independent party. Almost always will hold up if you ever get audited, because of the gain. The reason being because of the gain or loss from the sale of business property. Okay, now, so we got off.
What about the portion of your telephone bill?
Yeah, the question was, what about a portion of your telephone bill? On Schedule C, here I am. Although it's not itemized as an expense here that you can take, if you notice line 27 says other expenses from line 46 on page 2, that's where you would put your telephone expenses. And you can, even if you don't have a home office, an allowable home office under the tax rules, you can deduct, of course, any long distance related to your business, but you can also look at your phone bills over your 12-month calendar year period and figure the percentage business use of your phone, compare the total expenses related to your business to the total of all your phone bills, and take the monthly charge that the phone company charges you as a business deduction. Yes, sir.
You have a line just dedicated to your business?
Oh, that's real easy then. If you just have the question was, if you have a line dedicated to your business, that's perfect. All you have to do is add up 12 of those bills and you've got, of course, if the IRS ever found a personal phone call on that phone bill, you'd be in deep, deep doo-doo. Okay. Yes, ma'am. Yes, ma'am.
If your phone is not listed to the telephone company as a business phone, if you're not paying a business rate with the phone company, can you still deduct it?
The question is, if you haven't told the phone company that you're using your phone for business purposes, phone company probably doesn't care. Because you're talking about sharing a line.
No,
or
you have a phone coming into your house.
Mm-hmm.
Okay, it is not listed with the phone company. That's listed as a residential, but not as a business line.
Yeah, that's more of a problem between you and the phone company as opposed to you and the tax authorities.
The problem with the IRS, if you're writing it off, is that you could not write it off as an expense if it was not listed as a business phone.
That's not the case. I mean, particularly if you have a particular line that you just use for your business and you document, you know, if you log your phone calls on that or on a shared line, exactly. Yeah. The comment was it would be easy to document if you used that phone number in your advertising.
Experience on that, certain phone companies are being very, very strict about that. And you can get, as I understand it, fraud or theft of services. You may not have your business card.
Yes.
That comes
The comment is that the phone companies are really getting strict with the use of personal lines for business. And as I said before, that's a problem between you and the phone company. But the IRS is going to look at the actual business use, whether it's your personal line, a separate line, shared line, whatever. The question was, is there any difference in relation to sailors? I thought we were getting way too serious here. My favorite subject, sailors. Okay. Cellular, no, because you receive the same type of bills. I don't have a cellular phone, but you receive the same type of bills for cellular that you do for a regular bill. I guess there's a monthly service charge related to that, just as there is with your home phone. And what you need to do there too is to be able to document the business use of your cellular phone as compared to your personal use. It itemizes. Oh, that's nice. That's nice. Now I'm truly lost here. Hold on. Let me back up here for a second. Take a breath. Clothing. Karen had mentioned that there was a question as to whether a caller's clothing would be deductible. Of course, the rules related to the deductibility of work clothing is that as long as it's not suitable for regular everyday wear. Now, I realize this is a partner's dress as opposed to a caller's dress. But not always? I'm sorry, was I just sexist? Yeah. But I don't know. I saw an outfit like that over at the grocery store the other day. No. I think that you have a good case for deducting your work clothes. The work clothes of the caller. Now, if the partner is not an employee of your business, then the clothes for your partner. Now remember, I prefaced this entire talk by saying I was conservative. Would not be deductible. And besides, this is being taped. Okay. Yes, ma'am.
Well, but back to the clothes for the collars. You know, I could go into a country western store and buy 5 long-sleeve, nice Western women's shirts to wear with my long skirt that I only ever appear in as collar.
Yes.
But the IRS looks at that and says, those are perfectly acceptable street clothes. Why are you claiming that? Is that not, can I claim that fully?
I think what you need to do is to work on the justification. For instance, there was a case of an art teacher that bought smocks. Although you can wear a smock anywhere, since she just used that at work, and it was, you know, to protect her street clothes, her smocks were deductible. There was a hospital worker who wore jeans and like denim shirts at work. It was kind of an orderly type person, even though that's street clothes. Because he worked with extremely infectious patients, he never took those clothes home, always left them in his locker and had the hospital laundry take care of them. The IRS allowed that deduction because even though they looked like street clothes, the exclusive use of those clothes was for work. Now, I'm not saying that the deduction for clothing would be an easy one, but I think it's doable. Yes, sir.
What we do on our, we haven't tested this on audit.
Okay.
But we list clothing as a costume, right?
Ah, that's very good. Let me write that down. The comment was, in case you couldn't hear it, or Mr. Tape Machine couldn't hear it, was that they put the clothing cost on their tax return as a costume as opposed to work clothing. And no one has had that questioned? That seems to be the thing to do then. But that's very true. Yeah. Yes.
So it's part
I have a separate room and separate closet for it, too. It does not get mixed in with my street clothes. It's totally separate.
So in your justification, if you were questioned, you bring in your friends and family and say, this person never appears in this anywhere else but the call. But I mean, what kind of justification do they believe besides you telling them you only use the call?
Like I said, it is a gray area. But if and I'm sorry, I've only been to one square dance in my entire life. I was, in fact, I was thinking about becoming a dance major, and my mother asked me to go to a square dance. I was in excellent physical condition. I was going to be a ballet dancer. I went to one square dance, and I was 19 years old in perfect physical condition, and I was sore for 2 days after square dancing. So I really am impressed by you people. I've only been to one square dance. The costume worn by the caller at that one square dance, I think, would be justifiable. You know, it had the outlandish fringe and, you know, the colors. You know, I think the justification to the IRS agent would be, I have better taste than to wear this on the street. Yes, sir.
After being audited and having that question come up, having two different auditors, the chances of deducting it are practically zero. My experience, because they stick right to the rule that anything that can be worn on the street is non-deductible.
Yeah, an auditor will take the letter of the regulations. If I'm conservative, I wouldn't probably take it unless I was wearing clothes closer to these beautiful costumes you see up here. If it was a fringe shirt with jeans, I probably would not take it. But I'm not convinced that you couldn't. There's different levels of clothing, and there's different levels of costumes, and I think you have to think in your own mind. You can't make some blanket rule of thumb on the deductibility of the costumes you're talking about. I think you need to to think about what your costumes are like, and talk about it with perhaps your personal accountant, because it could be on a case-by-case basis. I have a lady at the microphone here.
I just wanted to give the other side of Bob's, because we were audited about 5 years ago, and our costumes, which were always listed as costumes, were allowed.
Did they ask questions on it?
Yes, he asked us what kinds of things we wore, but they were not the kinds of things we were wearing in the office the 3 days he spent with us.
Oh, good idea not to wear your costume to your IRS audit.
Well, we had a business audit. He came to us and was in the office for 3 days. But the costumes were allowable, so it may vary from agent to agent depending on how they interpret the law.
That's right.
We've been lucky in all the years we were in calling. We've always deducted the costumes. And I was in business with my husband, so my costumes were deductible too.
What year was that?
They audited us for 88 and 89, so I presume it was in fall of 90.
Yeah, the spouse's clothing would have been deductible at that time.
Mm-hmm.
What did that change?
I'm going to say 1993.
But if you're a partner in the business...
If you're a partner in the business...
Your clothes are still deductible.
Because you are a part of the business, right?
We were also audited, and the caller, all of his items were allowed. The spouse was not, unless she were a caller also or part of the business.
What year was?
I don't remember. It's been several years back. We haven't been audited recently.
Good. We should. You know what? This is such a gray area, and we only have about a half hour left. If you'd like to talk about this afterwards, maybe we should move on just a little bit here so we can get through the other items. Because I'd really like to get to travel and entertainment costs. December 31st, 1993 was the last time that you could take travel expenses for your spouse. Now, the vagaries of this partner issue in the square dance calling, I'm not going to be real clear on. The square dance I went to, this guy was doing it all by himself, and he ruined me for life. I decided not to be a dance major. I thought, I can't do this. Travel costs are fully deductible if incurred in your business. Meals, however, are only deductible 50%. What kind of things are deductible expenses? Well, you've got hotel, you've got airfare, you've got train fare. If you have to ship anything to, like your sound equipment, if you have to ship it ahead of you, any costs related to that. Cleaning, laundry expenses while you're on the road, telephone calls, of course, while you're on the road, tips, taxis, fares, tolls, of course, things related to your car, which we're going to handle next. Those are the types of things that are, at least at first glance, deductible. I'm sorry? Meals and entertainment, 50. Everything else, full. Spouse, none. What you need to do is to document your travel and entertainment expenses. Gifts. I don't know if you ever give gifts. They're limited to $25 per person per year. And the IRS will, if you get pulled in for an audit, probably not going to be a big item on your return, gifts. But if you ever get pulled in, they will look very closely at that to make sure that it is a valid business expense as opposed to personal expense or something like that. What you need to document in most, I'm sorry?
Talking on those expenses, like coming to CALLERLAB, that would be the convention expense would be deductible.
Mm-hmm.
But now the meals are included. Would we have to separate that, or can you take that as one deduction?
Well, was it included? The question was, coming to CALLERLAB is a convention and it's deductible, but the meals are included. So with the meals, would you have to break that out and take 50%? Were the meals included in your registration fee? Then it's fully deductible. It would, well, there is no convention line item. I would put it in under education myself if you go to conventions or classes or things like that. That's another thing too. If you take classes, don't forget, because it's not a separate line on your Schedule C, to take any expenses related to those classes on your Schedule C. Documentation, I'm sorry. Yeah.
From previous discussion, you're saying that the partners won't be deductible.
What is the business relationship between a partner and a square dance caller?
Most partners, they're partners. Yeah, they really are partners. It's a dual role. Most partners do all the bookings, all the arrangements, and do all of the PR work on the board.
Well, when you file a tax return, do you file a Schedule C or do you file a separate partnership return? It's a C. So, what's the name of the business? Usually the caller's name? I'm thinking in that kind of a situation, even though the caller would not pay the partner, right? Because they're usually married. Well, I didn't say there weren't any fringe benefits to being a partner. I'm talking about wages. Yes, sir.
Yeah, my name is Ronald McCravey. I'm from O'Fallon, Missouri. My wife and I work square dancing, country western, and we have a sublimation business and things like that. Usually the business is broken down as square dancing, country western, or sublimation. Mm-hmm. However, we work as a unit, and basically we don't make any differentiation, and so far it has come out fine.
I think that's a very justifiable stance to take, since the partner is an integral part of the business.
Your partner in square dance calling is usually a sound man for you. She's the one that takes care, if you're lucky, and she's big and burly, she takes care of all your problems.
Yeah. Right. Okay, so in that case, the non-deductibility of spousal expenses, the non-deductibility of spousal expenses would only relate to a spouse that was not helping you in your business. Yes, ma'am. Mm-hmm.
2 hours away, 3 hours for that, 2 hours home.
Mm-hmm.
That's 7 hours. But we were told that we still like not to get the meals.
There are rules related to that, and I'm going to have to look that up. Okay, because it's something to do with hours of what time. Like if you left at 6 o'clock, I think you can take a meal, but I'll look that up.
How many miles from? What was brought up? If it's 50 miles from your home base, you're deducting meals.
Well, let's talk about the documentation for travel and entertainment expenses, because if you ever get pulled in for an audit, then you're going to need to have the correct documentation. Karen had mentioned in her letter that she sent to me that she has a American Express Gold Card that they send an itemized statement at the end of the year. That's real helpful in giving something like that to your accountant to help prepare the return, or if you're preparing your own return. The only problem with that is that it's not going to have all the detail on there that the IRS is going to require to make those expenses deductible. So what you're going to want are the actual receipts. For instance, on travel, you need the amount, the time, the day and the time that you left, and the day and the time that you returned, the place where you went, and the business purpose for the travel. For entertainment, you need the amount of each separate expense. If you're entertaining potential clients or whatever in a restaurant, the restaurant receipt should have, of course, the amount on it. It'll usually have the date that you were there. But what you need to, pencil in on the back of it is the names of the people that were there, the business purpose, the business discussion that went on, and the business relationship between you and the people you were entertaining. And it's also, helpful in some businesses, but probably not so much in calling, to actually put the occupations of the people there. They're tightening down so much on this because there was so much abuse, so many years ago with the 4 martini lunches or 2 martini lunches or whatever, that people were trying to charge through their own expenses as entertainment. They will also take a look at these types of expenses to make sure that they're not extravagant. That they will limit you.
Burger King meals don't usually come under extravagant.
Burger King meals are not extravagant.
That's what most of it is.
And just make sure you get a receipt, and but I'm not real sure. I think it's a gray area on those bacon double cheeseburgers. Transportation, and of course any any airplane fares that you've incurred, train fares, taxi fares, that type of thing. Let's see. Then I had, here we go. Is there a chance that people travel outside the country? Okay. There are a couple special rules for traveling outside the United States. I'll be with you in just a second. You can deduct all your travel expenses when you travel outside the United States. What these rules are relating to the IRS believing that you really aren't doing business outside the country, that it's really a personal vacation. That would never, ever be the case, would it? But you can deduct all the travel expenses if one of the following applies. That you don't have substantial control over the arrangements for the trip. But the IRS has historically believed that if you're self-employed, you have substantial control over the arrangements for the trip. The second one is probably an easier one in most cases, if you were outside the United States for less than a week. And the third one is if you spent less than 25% of your total time on non-business activities. If any one of those applies, then you can take the total expenses for your trip outside the country. If they don't apply, then what you have to do is to allocate your expenses on a day-by-day basis. Was it a business day? Was it a non-business day? On down. It's for hotel, fares, the whole kit and caboodle. But if you can make any of those 3 items apply, it's much easier. Yes, ma'am.
Hi, I'm Peggy Christian. I have one question going back to entertainment. Having worked in private industry, I know that there were rules regarding the claiming of expenses for a cocktail prior to a business dinner. Can you comment on that with regard to us as to whether or not that is or is not an allowable deduction?
I have read that if you have a cocktail before a business dinner, it's the same kind of rules that apply. Like if you're going to go out to dinner and then go to a ball game or a movie or something, you probably wouldn't take a business client to a movie, but a sporting event or a theater, some sort of auxiliary activity related to the meal. That if it's a properly documented business entertainment type meal, then you can actually take the expenses of the auxiliary, like for having a cocktail before dinner. Not a problem, because you've documented the business reason for that meal. The only codicil, and they always, the tax code's all full of these except fors. If you go to a sporting event or a theater production and have to buy your tickets from a scalper, you can only deduct the fair market value of the ticket, not the scalped price. This is big in Pittsburgh. I don't know about where you're coming from. This is big in Pittsburgh. Okay. Let's see, travel and entertainment. I'm sorry? Yes. Next, capital assets. Okay. First, we'll talk computers. Sometimes it's a little hard to get the computer expense if you have a home computer because you use it both for personal and business. I don't know if we're not to that point at our house yet where we have a separate computer for business that we do, than what we play games on. But it is possible to deduct if you document the use. What you need to do is just keep a log next to your computer, and you need to log the time spent on each time you turn the computer on and for what for what reason. That way you just take the percentage of time used for business compared to the total time, and then the expenses related to the purchase, which we'll go into a little bit more, maintenance, upkeep, software, that type of thing. The business use of that will be deductible. It's just real important to keep a contemporaneous log like what you do in your car. You can depreciate computers. But I would suggest, since they have something called the Section 179 deduction, where you can expense items instead of depreciating them, this is a really good thing for getting your income tax liability quite low. You can take $17,500 worth of Section 179 expense. That's the cost to purchase computers, cars, assets used in your business, as long as the $17,500 does not take your your self-employment income below zero, or does not take your personal income below zero. If there is a piece of that let's say your income from self-employment was $13,000, and you bought $20,000 worth of equipment, and you wanted to expense $17,500, you can take $13,000, and you can carry forward the $4,500 to the next year, but you're going to be limited every year that you don't take your income down to a loss situation using the Section 179. I just wanted to go back to one more thing on home office deductions. I just ran across it in my notes. Attaching the form, and the form is in your handouts for home office deductions, Form 8829, will increase your chances for audit 1,000-fold, because it is so difficult to take the deduction that they're almost going to automatically pull your return and review it. But if you think it's a valid deduction, just because it increases your chance for audit doesn't mean don't take the deduction. Automobile expenses. There are two ways that you can keep automobile expenses, which relates to what you had mentioned earlier. Your actual expenses or your standard mileage deduction. Under the standard mileage deduction, it's the easiest one. You usually get a little bit less deduction than using actual expenses. It's 29 cents a mile for all your business miles that you put on your car. It takes into account gasoline, depreciation, oil changes, and things like this, so you can't, in addition to the standard mileage deductions, take these other actual expenses. If you use the actual expense method, it's a little bit more record keeping, but it will more than 9 times out of 10 result in higher deductions for you. That's depreciation, if you have to rent a garage to keep your car in, gas, insurance, if you lease your car, licenses, oil, parking fees, rental fees, repairs, tires, tolls, anything related at all to your car. The business use of your car you can take as a deduction. The interest on the business use of your car is deductible in certain cases. The best foolproof way to handle buying a car, though, instead of taking out a regular car loan, since you're going to use it partly for personal, is to take out a home equity loan to buy a car. Under depreciation, you can either take a straight line. Let's say your car cost, I'm going to try to think of something that's easy for me to divide by, $10,000. The useful life of a car, according to the, I have this in your handouts here, the useful lives of cars. It's on MACRS depreciation under GDS. We CPAs like to use a lot of these initials because it makes us feel important. That's modified something. Okay, it's But the useful life of an automobile, under no matter what method you use, is 5 years. If you use straight line method depreciation, you would take your $10,000 car, divide it by 5, that's assuming you bought it on January 1st, and take that amount of deduction. The MACRS is an accelerated method of depreciation that will give you much higher deductions in the early part, right after you purchase your car, than at the end. Those percentages are here under optional makers tables, half-year convention, percentage, mid-quarter convention. The mid-quarter convention, you have to use those percentages if 40%, is it 40? I think it's 40. Yeah, if you purchase assets for your business and over 40% was purchased in the last quarter of the year, then you have to use the mid-quarter convention, which will give you a smaller deduction if you bought everything at the end of the year, because you can see that the third quarter, if you bought it in the third quarter, it's 15%, fourth quarter it's 5% for the first year. The half-year convention is what you would use if you didn't buy everything in the end. This was done just to prevent people from trying to, load all their asset acquisitions into the end of the year just to get the accelerated depreciation. The IRS caught on to that after a couple of years and came up with something that will keep accountants in business for a long time. This is an accelerated method of depreciation that will give you higher deductions. It is a little complex in the tax laws, so if you think that this might be something you'd be interested in, if you're going to buy a car for your business use, I would strongly suggest having an accountant help you out with this instead of trying to muddle through the whys and wherefores of the tax code on this. It's not really, 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 really difficult, but if I didn't have to do it, I wouldn't. I'd have somebody else do the calculation for me. Sound equipment, I'm not sure, but under the useful life part of the upper part of this schedule, I would assume that the IRS would ask for 7-year life on sound equipment because it's not included in any of the other classes that they have. And what they did was they defined all these classes, and then if they left anything out, they said, well, you have to use we don't care what it is, you have to use 7 years, even though I'm sure your sound equipment probably doesn't last anywhere close to 7 years. But the thing is that the year that it dies, you can take the rest of the depreciation on it. I just kind of sped through that pretty quickly because I think I only have about 5 minutes left, but yes? Yes. Yes, it's always suggested, it's always recommended to just keep that log in your car, whether you use the actual expenses or the mileage deduction. You want to keep a log in your car and log your odometer reading at the beginning and the end of every business trip. I always, when I was on the road a lot, I just kept it all. I just, this was, my odometer's at 3,300. I'm going on a personal trip. Because the more detailed that log, the more acceptable it's going to be. Yes, sir.
Before we run out of time, I'd like your opinion on having to file in multiple states if you receive 1099s from different states.
That's a good question. That is a real good question because you would have been calling in the different states, right?
Right.
You would have called in like five different states.
According to our tax preparer, we had to file in 7 different states.
Yes, I was about to say, if you do business in the state, then you're going to be required to file a state return in each state that you do business in, that you earn income in.
Well, her opinion was that the computers are getting so sophisticated that you either do it now or possibly do it later with penalties.
That's exactly right. They are matching up. Refunds are taking longer, everything's taking longer. They're matching every return this year, Social Security numbers, 1099s with your Social Security number to your tax return to make sure that you reported every 1099 on it, and they're getting really, really detailed on this. And the federal government also communicates with state taxing authorities too. So if you have an audit that has an adjustment that results in higher federal taxes, the federal government is going to contact your state, and you will probably get a letter from your state taxing authority saying you owe me taxes too, depending on what the adjustment was for. Yes, sir.
I was interested on square dance callers calling benefit dances for charitable contributions. If they're doing it either the full dance or part of a dance, what sort of deductions can they take on that?
Well, you cannot deduct anything for your time. But you can deduct any expenses that you incurred in getting there. I think you would have a hard time deducting if you were just splitting it between contributed and paid. I think you'd have a hard time deducting that. But what you also want to remember too is that mileage rates too. If you use your car to get to a call where you're going to not charge them anything for charity, that rate, I believe, is 12.5 cents instead of the 29 cents charitable deduction. Yes, ma'am. Sure.
On our taxes, when we increase for the, like if it's 20 additional amount, would it really better to, like, increase the deferred time to actually lower your taxable income, or would it be better to increase the additional amount?
Well, I'll tell you what, anytime you have an opportunity to, if you had a choice like that, am I going to pay the federal government something, or am I going to put something away for my retirement? I would, anytime you have an opportunity to do something like increase your deferred comp, I'd jump on that in a minute. That would help you. It's going to be a difficult calculation, but just sit down with a piece of paper and extreme quiet and a calculator. You can figure that out. Yeah. Yes, sir.
I seem to remember back in my past that there was a limitation of some sort on deducting mileage if the vehicle had over X number of miles. Is that still in there, and do you know what the mileage limitation is?
Yeah, that's, that may have changed. I'm sure it's still in, but the number of miles may have changed, so I want to look that up, and I'll look that up for you right after this. He's right that you cannot deduct forever once your car hits a certain number of business miles. You can't take the full 29%, the 29 cents.
You say business miles,
yep.
So if the car has got, say, 100,000 miles and 20,000 of those are business miles, is it counted as 20 or is it counted as 100?
Just your business miles. Yeah. Yes, ma'am.
You attend the weekend of the dance, and during the course of that weekend, you attend a caller clinic or a caller workshop. Can you deduct any part of that to make sense?
I think you could, particularly if there was a fee related to the class. You could for sure deduct the fees related to the class. Depending on what the split of time was there, your chances for deductibility get lower and lower and lower on deducting a percentage of that cost. They do that to keep you from having conventions where you have like one class on Monday morning and then nothing for the rest of the week, to get personal vacation to be deductible. Was there another question over here?
How much did you earn on the 1099 you were made before that?
The question is, how much do you have to earn to get a 1099 from somebody? And the answer to that is $600 over the course of a year. So if you've got $300 one time and $300 another time, they should be sending you a $600 1099 at the end of the year. State laws vary, so they may or may not be reporting it to the state. In Pennsylvania, you don't have to report it to Pennsylvania. I think we're out of time. We didn't quite get through everything, but I'll hang around for a few minutes if anybody has any questions. And I really enjoyed this, and I hope you enjoy the rest of your convention.